the ICT Concept Indicator, which is available for various platforms on the TradingFinder website. From this section, you can download the indicator file for MetaTrader 4 and MetaTrader 5 platforms and run it on your chart. Traders can also read this page to learn about how the indicator works and its functionality. From the Navigator section, you should carefully select the expert file and then proceed to run the expert by simply dragging the file directly onto the active chart. Next, navigate to the Dependencies tab, and within this particular tab, you must enable the crucial Allow DLL Imports option to ensure proper functionality and integration. After that, go to the Inputs tab, and here you need to enter your dedicated license for this expert. To get your license, go to the TradingFinder website and request your dedicated license for this expert from the Support section, then enter it here. Just make sure to note that the license you receive is only valid for that specific device and will not work on other devices. Also, from this same tab, we can enable or disable the pop-up alert notifications. In the next inputs, we can enable or disable sending notifications to the mobile, and finally, in the last inputs, we can enable or disable sending alerts to the mailbox. If we set this option to true, we must have already completed the email settings in the Tools tab under the Options section. Alerts are only triggered for us in two specific situations. The very first instance is when the price reaches a valid and significant zone for the first time and subsequently touches a fresh, untouched zone, in which particular case, alerts are promptly issued for us. The second important alert is when the price decisively breaks through these previously valid zones and effectively invalidates them, after which alerts are also immediately issued for us. When you run the Expert Advisor on the chart, a management panel for ICT Concepts is displayed on the chart. ICT-style traders can use this Expert Advisor to identify market structure, detect institutional and bank orders, and enter buy or sell trades in the market based on liquidity levels. In the panel section, we can manage various settings such as displaying zigzag lines, order block zones, broker block, FVG, IFVG, BPR, kill zone, market structure, unicorn model, and finally, this document section, where we can activate or deactivate different options. In this section, we can also see that a warning message has been issued for us regarding a broker block zone being touched. In previous messages, we can also see warning statuses related to various zones becoming invalid. Additionally, traders can easily move the expert panel on the chart by hovering the mouse over the top of the panel and clicking on this section, transferring it to their desired position. Or, by clicking on the Minimize option, we can reduce the expert panel to its minimum size, which only displays the remaining time until the current candle closes. By clicking on this section again, the expert panel will return to its default display mode. The first option is the Zigzag section, which, when enabled, allows the indicator to start identifying swing highs and swing lows on the chart using a specialized formula, and it draws zigzag lines on the chart. This section enables traders to identify the main trend. And traders can use the zigzag lines and swing highs and lows to identify Elliott waves and wave counts, or to spot swing highs and swing lows, or to plot Fibonacci levels and confirm price patterns. Based on these lines and identified pivots, they can analyze market positions and structure. In the next mode, we can activate the order block feature. By enabling this section, the expert advisor starts to identify areas on the chart where banks, large institutions, and smart money place their major buy or sell orders. And when the price enters these zones, we can observe reactions occurring here. For example, in this section, we can see that an order block zone has been identified for us, and as the price returned to this area, we entered a downward trend. In another part, we can also see that a bearish order block zone has been identified, and as the price moves upwards and enters this order block zone, it reacts and moves downwards again. We can observe multiple reactions to these order block zones. This expert advisor identifies valid zones and those that have not yet become invalid or been broken, and marks them for us, so that we can enter buy or sell positions in the market based on price reversals. In the next section, there is another mode called broker block. By enabling this option, the expert advisor starts identifying broken order blocks on the chart. Broker block zones are the same as order blocks, but with the difference that their nature has changed. For example, at this point, there was a bullish order block zone, and as the price moved downwards, this order block zone became invalid and was broken. This caused the order block zone to turn into a bearish broker block zone. When the price returned to this area, we saw that it acted as a resistance zone, with the price reacting to it 3 times and being rejected each time. As long as the price does not manage to break and close a candle above the bearish zone or below the bullish zone, these zones are considered valid and reliable. Here, we can see that the price moved upwards, reached this level, but failed to close a candle above the zone and moved back below it. It only consumed the liquidity of this zone and then started to drop. The next scenario is the FVG or fair value gap, which is a candlestick pattern on the chart. The expert identifies these areas as gaps in the market, indicating that the market was not balanced at that point. Usually, the price tends to return to these zones and fill this gap, which in the future acts as a magnet. Here, the price has entered the FVG zone. It has entered again and each time has tried to bring these imbalanced zones back into balance and then continue its own trend. Here we can see that there is a gap between the first and third candles, and this price gap between the first and third candles gives us a zone which we call FVG or fair value gap. The price has reacted twice to this bearish FVG zone, which is marked in red, and started to drop. Or in this part, bullish FVG zones have formed, and here the price has reacted to them and moved upwards. Another FVG zone has formed here, where the price has pulled back to the zone but has not managed to break through it, and each time the price has been rejected. The next scenario is the IFG, or inverse fair value gap, which indicates an imbalance of supply and demand in the market, or imbalance. This means that buy and sell orders were not balanced, and the price moved sharply and suddenly, passing through those zones. Here, a bearish FVG zone had formed for us, and as the price moved upwards, it broke through the bearish FVG zone. When a bearish FVG zone is broken, it changes its nature and turns into a bullish IFVG zone, which is marked in green for us. In this part, we can also see that a bullish FVG zone had formed. The price moved downwards and broke through the bullish FVG zone, causing this zone to change its nature and shift from a bullish FVG to a bearish IFVG. we can see that whenever the price returns to this zone, it reacts each time and gets rejected from this area. The next scenario is called BPR, or Balance Price Range, which is formed from the overlap of two FVG zones, one bullish and one bearish. It indicates a place where the market is gathering momentum for its next move, and we can use these zones as entry points for trades, as the probability of success is higher in these areas. For example, here a bullish FVG zone was formed, and then at this point, a bearish FVG zone appeared. The overlap of these two zones creates an area for us that is considered a bearish BPR zone. If the price returns to this zone, we see a strong price reaction, and as you can see, here too a bullish FVG zone has formed. The price was not able to break through the bullish FVG zone here, and after that, it made a strong move downwards, which also formed a bearish FVG zone here. Ultimately, the overlap of the bullish FVG zone and the bearish FVG zone creates a bearish BPR zone for us, and if the price returns to this zone, we can expect to see some reactions. Or at this point, a bullish BPR zone has also formed, which is shown in green, and as the price reaches this zone, we can see that it pushes the price upwards. The next mode is the kill zone mode. By activating this mode, the expert starts to display the golden hours of London and New York, during which liquidity reaches its peak. These periods are the hours when banks and major institutions become active and heavy liquidity enters the market. Usually, the best opportunities occur during the London kill zone and the New York kill zone, which we can take advantage of. The Asian kill zone, which is shown in purple, is marked for us from 8 p.m. to 10 p.m. New York time. This is one of the least liquid kill zones. The next kill zone is the London kill zone, which is marked from 2 a.m. to 5 a.m. New York time. Finally, the next kill zone is the New York kill zone, which is displayed in pink and is marked from 7 a.m. to 10 a.m. New York time. You can use these trading opportunities to enter trades. For example, by enabling the order block zones and displaying the kill zone areas, we can see which order block zones have formed during the kill zone times. If an order block forms during a kill zone and at an appropriate time, we can use these opportunities to enter a trade. For instance, here in the London kill zone, a bearish order block has formed. As the price moves and reaches the New York kill zone, if the price returns to this area, we can enter a sell position in the market. After that, the price has moved downwards. The next mode is the market structure mode. By activating this mode, a framework of price movement is drawn for us and displayed on the market. Traders can use this mode to better understand whether the market is bullish, bearish, or ranging, and based on this tool, they can identify BOS, break of structure, levels, and COCH, change of character, levels. For example, here we can see that the price has moved downwards, broken a COCH level here, and the market, which was previously in an uptrend where there was also a COCH broken upwards, has shifted. The market trend was bullish, but it failed to continue the trend, moved downwards again, and here too, it broke a COCH level. After that, the price continued its downward movement, and we can see that each time it broke the previous low, it formed a BOS level for us, which indicates the continuation of the bearish trend in the market. Here, when a level is not broken, it is shown with a cross symbol. For example, here the low was a BOS, and if the price had managed to break this low at this point, the BOS level would have occurred for us here. But the price moved downwards and failed to break it. It then moved back up above the level. And here, a cross was displayed for us. In the next candle as well, the price tried to break the level but did not succeed. But this time, the previous level is no longer considered for us, whereas the second level is taken into account and the BOS level finds a gap and shifts to the next level, where again we see that the price has not managed to break it, and at present our BOS level is at this point. Once again, the price has moved upwards, experiencing its own fluctuations. At this point, it has tried to break the new BOS level. Here too, it has not succeeded. The BOS level moves to the next candle, that is, to this section. This process continues until the price manages to break the level, and in the end, we see that here too, in this candle, it has not managed to break the BOS level, and when the price was at this level, with this candle, it broke the BOS level, and finally, the BOS level has been displayed for us. Here, we can see the distance where the BOS gap starts, which begins from this point, and finally, at this point, the BOS level has been broken. As we can see, the price is forming lower highs and lows, and if a BOS level is broken, we can wait for the price to pull back to a suitable zone and then enter a sell or buy position in the direction of the market trend or in the direction of the CHO-CH trend in the market. The next scenario is considered the Unicorn model, which is a powerful trading setup in the market. The Unicorn model is a trading setup that combines several key ICT concepts, including kill zones, where entries should be made during golden times such as the London and New York sessions. A liquidity sweep occurs when the market first collects liquidity, gathering stop orders above the highs or below the lows, what is known as a stop hunt. After this, the market makes its move, and finally, there should be a breaker block formed along with an FVG, fair value gap. The overlap of these two zones creates the unicorn zones. To better understand, here is an example where we see the price has moved upwards. An order block zone was formed here. The price made its move upwards. It collected the liquidity in this area. A higher high was formed here compared to the previous high, then it moved downwards and at this point broke through the order block zone. Finally, with the formation of an FVG zone that moved downwards, the overlap of the breaker block zone and the FVG zone creates a unicorn zone for us, where we can see the price has reacted to this zone upon retracement. It moved towards the zone but failed to break it and moved downwards. Here too, as the price passed, a unicorn zone was formed. The price touched it and then started to fall again. A unicorn zone has been formed. The price touched it and started moving downwards again, which means by activating the kill zone areas, we can identify trading opportunities and the right times to enter a trade. Here we can see that the price moved upwards, entered the unicorn zone during the Asian session, and reacted again. Or at this point, we can see that the price entered the unicorn zone during the London kill zone and then started to drop. The last mode is considered as the inducement mode, where by activating this part, the indicator starts to identify deceptive levels within the market. This is very useful before the order block or FVG zones are formed. Usually, the market creates a support or resistance level to lure retail traders into taking the wrong positions. In the end, the smart bull uses exactly that level for its own entry, and after that, we see the price making its main moves. For example, at this point, we can see that an IDM or inducement level has been identified. The price moved upwards, collected the liquidity and stop losses in the area, and after that, we see it moved downwards. At another level, again, an inducement level has been identified. The price moved upwards, created a fakeout, but after that, you can see it entered a main trend in the market. And in the same way, we see time and again that the price touches these inducement levels, collects the stop losses and limits above or below these levels, and causes traders to enter a wrong position in the market. We can use this situation, along with market structure, order blocks, and FVG, to develop a powerful trading strategy. Based on price movements in the market, we can identify suitable trading opportunities and enter sell or buy positions accordingly. In the last two sections, in the settings part, we see that there are two options, candles to check and last blocks. In the first box, you can set the maximum number of candles to be used for identifying and analyzing the chart, which is set to 1000 by default. This means the expert advisor starts from the most recent candle or the current candle and moves back 1000 candles, drawing a vertical line on the 1000th candle for us. And after that, it starts identifying bullish and bearish trends and suitable zones in the market from this line, displaying these zones for us. We can adjust the number of candles to be fewer or more within the market. In the final and ultimate mode, there is also the highly useful last blocks option available. By enabling this particular section, I effectively activate the crucial order block zones right here on the chart, and by subsequently turning on the last blocks option, the indicator immediately starts to precisely identify and clearly display the last 3 significant bearish zones and the last 3 equally significant bullish zones directly on the chart, providing valuable insights for analysis. And LT, break time equals 0.5s and GT. However, if it doesn't identify any valid zones, it might only draw a single zone, or it might not draw any zones at all. For example, if the price moves down here and we're in a bearish trend in the market, and there are no bullish order blocks in our range, it might only draw the bearish order blocks for us. If the price has moved down here, there's a high chance that it will only display 3 bearish zones for us. Also, please keep in mind that the alerts issued for us are exclusively related to specific trading concepts such as order block, breaker block, fair value gap, FVG, imbalance fair value gap, IFVG, and balanced price range, BPR, along with the prevailing market structure at the precise time of a CHOCH, which stands for change of character, and finally, the concept of unicorn. These particular zones, if touched for the very first time, that is to say, if the price action touches a designated zone for the absolute first time, for example, this specific zone right here, it is then considered a fresh zone. If the price reaches this zone for the first time, an alert will be sent to us. However, if the price, for example at this very point, if the candle closes at this point, this FVG zone becomes invalid for us, and when a zone becomes invalid, alerts will also be issued for us. As we can see, the price has moved downwards. A bullish FVG zone had formed here, and with the price closing below the bullish FVG zone, this zone becomes invalid and is considered void, and it will be removed from the chart. Well, friends, we've reached the end of this Expert Advisor tutorial. I'd be glad if you shared your comments and suggestions with us in the comments section.